Hi, everybody. Welcome to the IC Topic Chat for today. It is Thursday, of course, as usual. It is noon on the Eastern time zone. I am in the 11 o'clock time zone. We always meet at this time every Thursday. So if you're available during that time, come join us. It is May 14th. I don't know. Is this a special day for anything? I haven't seen any holidays, or I haven't even heard any silly holidays for today. I always love the May the 4th, I celebrate Star Wars Day. One year we did a group run and I dressed up as Darth Vader and I we had to cross the road and I stood there with my lightsaber stopping traffic. It was classic. It was awesome. Anyway, enough about Star Wars Day and dressing up as Darth Vader. Uh, we're going to be talking about business structures today, which sounds super exciting. And so I love this little graphic here of what my friends think I do, what my mom thinks I do, what society thinks I do, what I actually do, what my customers think I do, of course, just sit around counting cash. Although, if you look really carefully, those are like $1 bills, which probably more accurate than not a lot of times. Um, but the big idea here is how do I set up this business thing? What does it look like? And what are those things that you think about? I should say I am not a lawyer. And I always like to say this with this because I'm going to give you guys a bunch of advice. And it's just based upon it's actually let's in the true tone of the chats. I tell you as much as I know, but I also claim not to be an expert most of the time, which is kind of the fun parts about these chats. And that it keeps me a little bit honest, but also I will say I'm going to say reach out to a lawyer, let them help you with this. Um, it's not it might cost a little bit of money, but it's going to save you hundreds, thousands, tens of thousands of dollars in the long run if you get this done right. And so when I was first setting up, this was the big barrier to me. I was thinking about this morning. It feels like there's a wall you need to break through. And once you kind of mentally get through the whole idea of how I set myself up as a business, a lot of things start to fall into place. And this is one of the big ones. But I will say, seek the advice of a local small business attorney, and those are the things you're going to want to look for. Don't try and reach out. If you're in Delaware, don't reach out to somebody in Nevada. Okay, if you're in Delaware, find somebody in Delaware. If I'm in Illinois, I'm in Edwardsville, Southern Illinois. I reached out to somebody in my community in Edwardsville, Illinois, and they helped me out. Um, so I absolutely suggest that they filed the paperwork for me. They submitted it, cost me a couple $100s. They advised me on what kind of structure I wanted to be in. And honestly, I had to go back and learn all the other ones because I didn't understand it. I understood what my type of organization was, which is an S corp. Speaking of which, here's the type of structures we're going to talk about today. So the main ones most on this list that most of us are going to identify with are sole proprietorship or a sole prop. You'll hear that used. Um, the um, You'll also see partnerships. Don't see that as often. You'll see C corps. You don't see that as often. You do see a lot of LLCs or limited liability corporations and S corporations. Some of you guys might identify as a nonprofit. Some of you might identify with a research institute, but overwhelmingly, the big three you're going to see are sole prop. That's where most of us start. LLC, which is I've moved to that point of wanting to protect my assets, and then S corp, which is a little more organized than the LLC. And there is a bit of a difference between those two, and we're going to get into it. And you can find that there's a hybrid between those two as well. You'll see the B Corp on here. B Corp's technically not an organizational structure. It's you identify as one of these others, and then you get um, a you go through a process kind of like an accreditation where people review who you are and to see whether you are a benefit corporation. You can be a for-profit corporation, but you want to identify with that. But we'll get to that in a second. So a lot of us start as sole props, the sole proprietorship. If you are mowing lawns and people are handing you cash, in many ways you're already set up as a sole proprietorship. There's things you should do beyond that, but you are being taxed that way. Anytime that somebody sends you a check for more than $600, they are legally supposed to um, find out about your information, get your social security number or your federal employer identification number. Some people call that a FIN number, and then send you a 1099 form. Okay. I also haven't stopped and said, I'm only talking from a US perspective. I have absolutely no idea how this works in Canada. I suspect it's similar, but if you're in Canada and you're going, well, none of this makes sense to me. Well, I'm sorry. I really don't know how it's set up in Canada. I'm only talking from a US perspective. So take that and understand that going forward. The sole prop, sole proprietorship, you should get a federal employer identification number. That way you're not throwing your social security number out there to people. And you can do that as a sole proprietorship. You should set up a separate bank account, which is what I did right away. Um, what you should know is that you are effectively operating a business that is an extension of yourself. So there's no you are assuming all the liability as an individual with your business. So if your business gets sued, you are getting sued as a person. If you get sued as a person, they can go after your assets as a business. That's the legal structure. Um, the pros, it's easy. It's easy to create. It's easy to terminate. It's under your control. The cons are there's unlimited liability, as you see right there. There really is no difference between you and your business. Now, you may set things up, and this is a piece of how you do setup, and I need to do another session on this. When you do a setup, you want to make sure you have your a different line of accounts, meaning you want to have a different checking account, you want to have a different credit card, so that you're keeping everything clean, right? At some point, you probably want to have an accounting system. I mean, you're in the early days if you have like one or two projects and you're um, bringing in, less than $50,000 a year, you could probably run this more or less simply through its own account, but you will probably need to think about how you do your accounting, and so you will eventually have to file taxes along these things. And your accountant, I would suggest you work with an accountant at some point. They'll need to understand how this all works, but they'll see this as 1099s coming into you as a personal thing, and then they'll want to see that you've paid taxes on that because the taxes aren't being pulled out by the people with whom you have a contract. Um, the hard to borrow money thing. If you need to borrow money, if you need like a small um, a small loan, just to kind of help you when you want to float between things, that might be complicated. It's better you'd have to set it up as a personal loan as opposed to one through the business. A lot of people ask, why would I want to move away from being a sole prop? And when we've done surveys, I think still 40 to 50% of our members, many of whom have been, I say members, ICTIG members, people involved with the topical interest group, the independent consulting topical interest group, remain sole proprietors long after they've started their businesses, many of whom long after they've exceeded that $100,000 mark, which seems to me about that time when you want to change. Um, and they have their reasons for that. The reasons why they have their own reasons for why they want to stay sole props. The reasons why I tell people to move away from it are taxes, liability. Those are the two big ones: credit or access to capital, and for honestly, security and continuity. The taxes meaning you will lower your taxes when you start to operate as an LLC or as an S corp. As an LLC, you are, well, I'll get into that when I get to the LLC slide. The main thing is the liability, because you are setting up a separate entity. And so if somebody, for whatever reason, has a problem with your company and they want to sue your company, they're suing you, but you are suing you as your company, as for me, Goshen Consulting. And they can go after the Goshen Consulting assets. If I'm doing everything right, I've kept Goshen Consulting separate from Matt Feldman and my family. They can't go after my children's savings accounts, which are also in my name, um, until they turn 21. We don't want that. They could go after my retirement accounts. Um, is it likely? No. Is it possible? Absolutely. Would it keep me up at night? Yeah, that's why I did that. So at a certain point, you have a big enough operation. You see that you're going to be doing this for a while. This isn't a side hustle anymore. This has become your livelihood. You probably want to think about organizing. All right. So partnerships in a general partnership, partners have unlimited personal liability for the debts and obligations of the business. There are, this is where if you're actually thinking about going into a partnership, talk to a lawyer. My experience with talking to lawyers about partnerships is they're going to talk you out of it. And there are legal partnerships that are like for lawyers who have partnerships, but they actually get very complicated the way they get into it. Um, Effectively, when you have a partnership, you're setting up a percentage of profit. And so if it's a 50-50 partnership, if you're putting in 80% of the work and the other person's putting in 20% of the work, technically at the end of the day, the profits need to be split by the percentages. And so that can be a problem. If you go to buying out and these sorts of things, if you go, it's generally it's not as elegant of a solution as perhaps an LLC. Um, let's see, unlimited liability, both you and the firm. You need a partnership agreement, which I think you should have a partnership agreement if you're in partnership with somebody else under another structure anyway. Um, it's only stable as long as all the partners can continue. So if one partner leaves, then you need to reform a new organization in that situation. Okay. Most people aren't going to set up a partnership that I listed there. The LLC seems to be the where most people start when they get into a corporation structure. So it's better for flexibility on how you manage and run your business. Effectively, the main reason for doing an LLC is as it says, limited liability corporation. You're limiting your liability to your personal self. You're still taxed as a sole proprietor. So when you if you take home an $50,000, you need to be paying taxes on $50,000 at whatever tax rate that is. Oftentimes it's like 25%, you're thinking. So you need to be doing that as a sole proprietor because it's effectively taxed as an individual, as if you were getting directly money 1099s and things like that. You don't have the advantages of the S corp in the way that you're being taxed as an LLC. Um, I'm just reading some of my notes. A multi-owner LLC is automatically taxed as a partnership by default, which is what we were just talking about. An LLC with one owner is a single member LLC. It's taxed like a sole proprietorship, or as they call it, I love this term, disregarded entity. You can tell what the IRS feels about how they feel about sole proprietors and LLCs. You are a disregarded entity. I'm putting that in quotes because that's their words, not mine. Um, anyway, um, one of the main reasons that an LLC is a great advantage for you is you set up and you're setting up a separate accounting system for your LLC. Whenever you have an expense, it's a business expense. It's a business expense before you see it as income and before it needs to be taxed as income. It's inside the business. You kind of have this business operation that's running. And so it's it's a great advantage to pay things before you have paid taxes on them. So if let's just say I want to buy a $2,000 computer, a laptop, right? If I need to buy a $2,000 laptop out of my personal funds, and this is the way you would often do this for business, I would receive money from whatever purposes for an income. I pay income taxes on that to the state of Illinois and to the federal government. And then now I have less. Let's say I had $3,000. Trying to do some quick math on that. You're talking about seven. So I pay about $750 out of that $3,000, right? Because that's in taxes 25%. Am I doing that math right? $250 times 1,000 anyway, $750. So now I have $2,250, and that's my money now post tax. Now I want to go buy a laptop and all the things that come along with it. That cost me $2,000. I have $250 left over at the end of that. If I get $3,000 from my clients in an LLC, it goes into my LLC business. And then I want to buy a $2,000 laptop. I buy a $2,000 laptop and I still have $1,000 left. It's pre-tax. And that's the big advantage. A lot of people don't think about that. What they say is, oh, well, that's a write-off. I love that idea. Write-offs are great. People say, why don't you take write-offs? Well, I don't take write-offs most of the time because I don't pay for things out of my personal income post tax. I pay for everything pre-tax. I pay for them as a corporation because those are business expenses. So I keep the business expenses inside the business, which hasn't been taxed for the money. I don't recognize the amount that the business has for taxes. This is an S corp conversation at this point, but I don't recognize my income on what the business took in until next year. So I have all year long to make money and spend money. And the only time I'm paying taxes as an individual or the corporation is when I see it as an individual. And so that happens next year. And I do need to be paying taxes in advance, but okay. Let's talk about the S corp. That's the kind of operation that I run. Um, one of the cons for all of this is you need to have filings to stay in compliance. So you're going to have some different kinds of filings. And if you will have a board, which oftentimes the board is you for me. And then because it's a corporation, you need to have a corporate board and you need to keep minutes and you need to do these sorts of things. S Corp's the same way. It's a little bit more admin than the LLC. Um, but it's really not that complicated. When it was an operation that was owned by my partner, my wife and I, we met once a year and it always involved sushi and I would give a review of everything that was going on. I think you can do this as a one person operation. I don't think you need to you can keep family members you're on your board, which might be just you and a child. Well, that probably need to be over the age of 18. You could be you and your partner, it could be you and your parent. That's fine. But you do need to make sure you're doing the work of doing a board meeting. And it doesn't need to be very complicated. It could be a one-page board meeting where you list some things that's going on with the business. And if you keep that paperwork, that's fine. Nobody's hypothetically ever going to ask for it. I've had the S Corp for 16 years now, and nobody's ever asked me for it. But if we ever got sued and somebody wanted to say, oh, this S Corp is a big sham, he's not really using it the way he's supposed to, they're effectively piercing the veil, saying there is no wall between Matt Feldman and Goshen Consulting. They want to pierce that veil. They want to get into they want to be able to sue me personally and then get into the business, or sue the business and get into my. I want to make sure there's a nice wall between those two. That's the veil they talk about. And the way you keep that wall established is by doing all the things you're supposed to for a corporation, which is annual meetings and little things like that. There are a couple filings you'll need to do with your state. In the state of Illinois, I think I pay the Secretary of State $125 a year to keep the name live. And there's a report, but it's nothing. It's just basically an update on our where we live, and they want to make sure our contact information is accurate, and they want their $125. That's about it. So this is the big question. How about an LLC that elects to be taxed as an S Corp? And when I got this question about 4 years ago, I was stopped dead in my tracks because I had no idea how to answer that question. So it's important to note that an LLC and an S Corp, you are effectively setting things up as both a tax structure and a legal structure. So an S Corp legal structure and tax structure, that's understandable. So when you want to be an LLC that elects to be taxed as an S Corp, effectively you're saying, I'd like to be taxed at a lower rate. And what that allows you to do is not see all the income that comes into the business as your personal income, which needs to be taxed as a disregarded entity, which is a higher tax rate. You can be taxed as an S Corp, which is at a lower tax rate. You have things called K1s, which is a document that says how much money did I take as a shareholder distribution, which is at a lower tax rate. And it's going to be different from wherever you live, but it's generally a better situation. That's why you'll often hear people who are in S corps who need to set themselves up as employees in S corp situation. Um, they now LLCs isn't it's not you that's it's a little more complicated. You can be an employee, you could be just an owner, these sorts of things. S corps, I'm both an employee and an owner, but I keep my salary very low. We pay ourselves, I think, $50,000 a year, which is lower than, well, most people would pay themselves when they own a business. But we keep it low because then we can have shareholder distributions, which is the piece. Now, we're also trying to keep things very trim this year to make sure um, we're agile and things like that. And so when there's extra money, we take that as a shareholder distribution, and that's taxed at a lower rate than my salary or anything that I would take through as a LLC or as a taxed as an LLC or as a sole proprietor. And this is where it seems complicated, but it's really not, because once you figure out how to become an S corp, you understand how to take a shareholder distribution and you pay less in taxes. And that's where you're like, well, I'd like to pay less in taxes. Okay, well, I'll figure it out. And that's why you ask your small business attorney to help you out with that. Or CPA accountant, they generally can do it too. Again, remember, you've got every time you're setting up a corporation, you're setting up two pieces: your tax structure, how much am I paying in taxes, and your legal structure. So you can be an LLC and get taxed as an S corp. And I'm sure we'll have comments about that when I stop the recording, and people will fill me in on how I said that wrong. There's the old style corporation, the IBMs of the world, or C corps, McDonald's. There are a handful of our colleagues who are C corps, and I think a couple of years ago we had somebody on who was set up as a C corp. It generally doesn't make sense for our type of business. No, I'll be told. Somebody will likely tell me how they are a C corp and they love it. You're taxed you're taxed twice, which is the key reason why this is a disadvantage. You're taxed on the corporate profits, and you're taxed on anytime you take distributions from the company as an owner. So that double taxation is the main problem. You must have a board of directors, and that board of directors needs to be people who are not from within your family. I believe there's stricter rules on meetings and keeping records. Um, if you're looking for investments, if you're looking to own property, a C corporation may be the right way to go for you. So oftentimes C corporations will have a large piece of property, like a building or multiple buildings, and and with their attorneys, they understand how to make that work tax wise. In fact, you'll hear people say, how does that person have so much in assets, but they never pay taxes? Usually it's because they understand how to work the system through C corps. I don't know how to work the system with C corps. I don't think I understand it well enough for us, where it's generally a we're white, not white collar. What I was going to say was we're knowledge workers, and we're paid for our time and our expertise. I don't think a C corporation generally works as well for our type of work, where the S corp seems to be the way most of us end up, and a lot of us will do that for our careers once we figure out how to set up that S corp. Let's talk about a B corp earlier. So B corp, you'll often see a B corp looks like that little logo there. B corp is not a IRS recognized corporate structure. You're some version of a for-profit usually, but you'd like to have that little logo that's placed on the side of your coffee bag there. There are B corps that are independent consultants, B corps that are evaluation firms. We'll see that they like it because they could say, I identify with my clients, and some clients are looking for that. They want to know that you subscribe to certain values. Let's see. Nonprofits may not become benefit corporations unless they switch to a for-profit structure. So if you're a nonprofit, this is for profits. So you see those pros of the personal value. You believe in this. Like, I want to give back to my community. I want to demonstrate to others. I want to have the logo on my website. I want people to know I'm a B Corp. And that's valid. It is basically um, more work, but if that's what you want to do, you should. And I think that particularly if it's part of your value system, you should adopt that. There's that B corporation logo again. Some people decide to go into to become nonprofits. In fact, I think this is pretty public. Our colleague Kurt Stuke and Associates is becoming a nonprofit, so they're switching over. There's a handful of other people who've done this for various reasons. I used to scratch my head and try and understand why. Why would you want to do that? It's just more complicated. And the reason is oftentimes it's kind of similar to a B Corp. It's a value system, but it also allows you to write for more grants. You have different kind of different doors are opened for you. Weirdly, we have STEM Camp, which is its own nonprofit, and we have a board, a whole bunch of people who are, as it says, the cons. You see, you have to have a board of directors to help manage everything, and those board of directors can't be all your relatives. They have to be individuals who are outside, and they have to meet more frequently. You have public records and public disclosure. Um, Weirdly, I had a client come to me and say, we'd like to do work with that's aligned with STEM Camp, but we get a better advantage if we don't work with the nonprofit. We want to work with the small business. So can we work with Goshen Consulting? And Goshen Consulting can coordinate the STEM Camp. So we went that way recently, which I never expected to hear that. But, I guess it just depends on what the grant opportunities are. Usually people see the advantages in the nonprofit. One of the most notable is if you can get your 501c3 status, you can have, and you need to register in your state. We've learned this too. Emily Johnson will tell you stories about this, but you do not have to pay sales tax, and that sales tax can be quite a lot for a lot of people. So, and that can be quite the advantage. For STEM Camp, we buy a lot of materials. And STEM Camp is for a real nonprofit. We're not hiding behind this nonprofit thing. We are absolutely dedicated to the nonprofit. We put together um the all the different types of documents that we need. We filed it all through, and it has a social mission to serve military connected kids and military communities for summer camps. But we don't pay taxes on those materials that we purchase for those students and we send to them. And so that's a huge tax advantage for us. But it is a lot more work to manage a board of directors, particularly a board of directors that may or may not want to show up to their meetings when they're supposed to. Ask me about that during the chat. We have a lot of experience with that. Some of you also may be thinking about becoming or starting a research institute or a center. Usually these are identified with a large organization, identified with a university. I got my start at a research institute at Iowa State University, the Research Institute for Studies in Education, or RISE. And that was the foundation for what I thought I wanted to do. So I went on to another institution, came up with this grand idea to become an evaluator and have an evaluation practice. And I wanted to create it as a research institute at my university. And they had no idea what to do with me, which leads me to the next thing, that there's a lot of cons to this. One of the major pro, it's huge, is you get that prestige of being identified with whatever major organization you're associated with. So in my community, if I were able to say I was from Southern Illinois University at Edwardsville, or St. Louis University, or Washington University in St. Louis, those are immediately recognizable names to people. And so if I'm a research institute at that institution and I put the logo of that university on there, they go, oh, we can trust this guy. He's at fantastic institution, whatever that one may be. And that's helpful. So you can and a lot of times people will start research institutes and they get the startup of their business is that much quicker. I think the cons on the other side of it is a lot more hard because you've got overhead. And when I say overhead, I mean literally the institution's going to want a percentage of whatever you bring in. And so when you negotiate a contract to do work for National Science Foundation, there may be a 51% indirect cost rate. So for every dollar that comes in direct expenses, 51% needs to go to the institution. So that's a major calculation that I don't have to worry about. Um, there's a lot of oversight, meaning you may need to spend a lot of time in meetings talking about things that are not your research institute. Oftentimes you'll be a faculty member and be sitting in on provost meetings and helping think through a lot of things that are not related to the work you're trying to do. It is a lot more expensive um, because you have to, I mean, it can be, I would assume for the most part it is, because you're going to be paying salaries at, um, negotiated rates that aren't necessarily tied to the type of work that we do. And so it could be less expensive, though generally it's going to be more, because then you also have the administration of those payroll and all that stuff, where you can keep it simple within a small firm, and there's just red tape. Anytime you want to do something, somebody needs to approve it, and it needs to go through some manual that you've never read. You got to go find whatever. And I think that's it. Those are all my slides. So with that, I'm going to stop share now, and I'm going to come back in, and we'll go into the questions and answer part. But before that, I'll say goodbye to everybody. Come back next week. Our next session will be on MOUs and pro bono grant evaluation writing. I'll be doing that session as well. And the week after that, I believe we're going to be doing a panel on recovering academics. Some of us who are recovering academics from being in research institutes. So there might be a tie-in to this discussion today too. So I see there's 33 comments. I haven't read a single one of them. We'll get into that in just a second. But with that, if you're here live, stick around. But if you're out in YouTube land, we'll see you later.